Great. Thank you so much, Ramon. I really appreciate it for all the work that you've done and the San Francisco Public Library to organize this great event that aligns with Financial Capability Month. Good afternoon, everyone. My name is Joaquin Torres, and I am your elected assessor recorder here in San Francisco. It's a great opportunity and time during this month to share with you an important topic that's related to property and your property. So today, we're going to dive into a very specific aspect of property tax law, and that is Proposition 19, and how it impacts property tax considerations when a property is being passed from one generation to the next. I'm going to be sharing general guidelines and explaining the rules that state law dictates and what you need to know from the perspective of my office of the assessor recorder. I want you to remember that taxes are a complex topic, and how they affect us depends very much on the individual circumstances of every individual. So there's no one-size-fits-all answer when it comes to tax implications or impacts. So reaching out to my office can be a very helpful first step for a thorough estate plan with the partners that we have, and also to navigate the complexities of asset transfers. Consulting with a qualified attorney is especially essential as well. Proposition 19 was a significant change to California's property tax system, and it's definitely impacted many people's financial plans, especially for those who are counting on inheriting property with a lower tax basis, and for communities that counted on their hard-earned assets to be transferred to future generations. As we all know, there are hurdles for communities of color to achieve homeownership, and there are systemic challenges to building wealth and also managing it effectively. These disadvantages create a cycle that makes homeownership even more difficult. And so part of creating this information platform is helping us to address that. So in addition to the role that we play in the city by generating $4.1 billion in revenue, we're also going to seek to be the source of financial empowerment for all of you throughout the communities of San Francisco. And it's something that assessors, not only here in San Francisco, but around the Bay Area and the state, are also concerned with. We realize that this is primarily through programming that we create that focuses on intergenerational financial literacy and education. We shine a light on the institutionalized discriminatory practices related to homeownership, and we have an estate plan program designed just for that, to help build and protect intergenerational wealth building for communities, homeowners of color, while also having a focus on how we can prevent displacement. My staff is here with me as well on the webinar and can take down your information from the chat should you have any more specific questions and you would like to get in touch with one of our subject matter experts around an issue that may be affecting you. So you should also have handouts to follow along with. So why don't we dive into the nuts and bolts of Prop 19? And you can see here the agenda that we'll be moving through. We have our assessment basics. We have Proposition 19, our intergenerational impacts. And then I'll talk about some very important dates to be mindful of for those of you who have property. I know that you've already paid your taxes that were due yesterday through the tax collector's office, but there are other dates to be aware of that affect how our offices functions as well. And then we'll have some questions and answers so we can get into some of the nitty-gritty details as we're best able to, or set up a time for you to talk to one of our specialists. Next slide, please. Thanks. So just a disclaimer here, everything here is not meant to be guidance or advice. We're providing general information. So please remember that your follow-up questions that are based on your individual circumstances are extremely important to bring to our attention so that the information that is best and most pertinent to you can be shared. And while that's the case, we want to make sure that you know that there are other resources around that can provide you with guidance and legal advice through attorneys or other nonprofit organizations that can also be helpful to you in that regard. So we're not providing official legal interpretations or guidance, but a summary of what you should know to inform your actions as a property owner and as someone who serves property owners. If you or if you're a realtor and your clients need advice on those specific situations, as I mentioned, please do consult an attorney. If someone you know or yourself is in need of a referral to an organizations that provide these types of services at a lower cost, we can also go over a few groups you can reach out to, and that'll be later in the presentation. All right. So here we are. Let's start with the basics. It's the assessor's job and the job of all the appraisers in this office to look at the full value or fair market value of the home at the time when there's a change in ownership, when someone buys and sells that property. And that becomes a basis, the foundation for the value that is your taxable value. And as you know, Proposition 13, which is part of the state constitution amendment that was passed in 1978, your property's assessed value cannot increase by more than 2% each year, but it does increase by 2%, no more than 2% each year. Proposition 13 also limits the property tax rate to no more than 1%, plus any voter-approved bond indebtedness. So if there's a parcel tax that's passed that benefits City College or other needs the city may have, that also is added on top of that 1%, and you typically see that on your bill. The secured property tax rate for the current fiscal year that we're in right now is 1.17%. Okay, so this is a great slide to understand the difference between what is an assessed value and what's market rate value. And this typically helps you as a homeowner understand the impact on property taxes when there's a change in ownership or when there's a new improvement, new construction, a remodel that takes place in the property that's done to a particular piece of that property. Generally, the assessed value is the fair market rate that happens at the time of ownership. So this slide shows what the home value is when it was purchased back in 1990, $100,000. Our office then assessed the value of the home at $100,000 back in 1990. As you heard me say at the beginning, Proposition 13 creates a cap, limits the rate at which that value can increase year over year, and that's the blue line that you see in this slide. So you can see that from 1990 to 2025, that assessed value has only risen from $100,000 to $196,000. Why is that important? Because you can see very clearly when you compare the difference between the blue line and the red line above it, which represents the market value of the property, meaning that a similar property of its type and size and location is selling on the market as of today at this much higher value. In this case, $1.2 million. The reason that there's a difference here is because Proposition 13, again, only allows the increase of that assessed value to move up each year by no more than 2%. Whereas the market, it's much clearer, especially in an area like San Francisco, how great that increase is year over year. You're in a home, then a home next door to you sells, they're definitively going to be paying higher property taxes than you are, depending on when they buy that home. So now, I'm sorry, maybe go back to the previous slide. So any changes to that in addition to changing hands, the selling of that property, the buying of that property, the change to that assessed value in the blue line can also be triggered by a title transfer or substantial construction work that is not about retrofitting for emergency disaster purposes. And there's very specific questions that people bring to our office, and we do encourage you to reach out so you can understand what those obligations may be. We also talk specifically about ADUs if someone is considering that, so they understand what the tax implications may be or also may not be, so that people understand that the value of their property doesn't suddenly go up to market rate because you've decided to add this type of improvement. Okay, next slide, please. All right, so we've gone through the basic framework of the Constitution through Prop 13 and what it provides. Well, there was a major change that took place in November of 2020 when it was voted on the ballot by the voters, and that was Proposition 19. the state measure that passed back on November of 2020, and that changed the state's constitution. It replaced older propositions, various numbers, 58, 193, 60, and 90. And Proposition 19 is a very complicated law because it changed the rules for two types of reassessment exclusions. So there are two major types that you see here. The first one is the base year value transfer. And the second is the intergenerational transfer exclusion, which is a little bit more controversial. The base year value transfer really was aligned with the home protection for seniors, those who were severely disabled, families, victims of wildfires, for natural disasters. The reason that was on everyone's mind is because back in November of 2020, as I'm sure everyone remembers, that's when we experienced when day was night, when the sky was orange. Excuse me. All right. So let's go into some more specifics in terms of the intergenerational aspect of Proposition 19. So what Proposition 19 intergenerational transfers did was it changed the rules that apply to transfers between parents and children and grandparents and grandchildren. It limits the type of property that qualifies to family homes only, meaning principal place of residence, where you live. All the other property types, second homes, commercial properties, those do not qualify. And the amount of the reassessment exclusion is capped at $1 million plus your home's base year value. So any value above the cap is then added to your original base year value. And I'll talk about that in a moment. So what are the qualifications for someone to benefit to the degree that you can of taking a property that is transferred from a parent to a child? Well, first, it's the principal place of residence. It's where you live. It's where you go to work from. It's where you receive your bills, your utility bills. It's where you vote from. So the person, to be eligible, the person transferring the property must have lived in that property as their primary home. The one receiving the property must also claim the residence as their principal place of residence, where you're going to live. Then there are requirements. The transferee must file for the homeowner's exemption within 1 year of the home transfer. And it's important, as this is a requirement stated by the state constitution, there's no exception. So there are a couple of things I want to make sure people remember if you're going to be pursuing this. And again, always reach out to our office with questions, but here are some basic components. If you don't have a checklist in front of you, don't take anything for granted. Reach out to our office. We want to make sure that you're aware of all the deadlines and all the forms that you are responsible for reaching out on. If you miss a deadline, that can have significant tax implications for you that can be corrected in the future. But if you don't qualify because a piece of paperwork was not filed or a deadline was not met, you're going to be on the hook for a higher tax obligation because during that time period, the assessed value of your home will be the fair market value of your home. And that can be a big difference, as you saw in that first slide, between the value of 1.2 million in that red line, if you remember, and that blue line of $192,000. So again, if you don't have a checklist in front of you, you want to make sure that you do. But if you don't, you want to make sure you understand what all the deadlines are and what all the forms are. And just having that checklist so you're thorough and reaching out to our office and asking all those follow-up questions to make sure that this benefit is provided to you to the fullest extent as allowed by the law. Some people ask what qualifies as a principal place of residence, where you live. To help you determine that, where you registered to vote, like I mentioned, the home address on your automobile registration, where you normally return to after work. If after you've considered all that criteria, you're still uncertain, choose the place at which you have spent the major portion of your time this year. Homeowners can show the principal place of residence by filling out the homeowners or the disabled veterans exemption form. And those claim forms are available on our website. at sfassessor.org. sfassessor, one word, .org. Here is another interesting component. So say you have a multi-unit dwelling. You're like, okay, great. Like I have my parents are going to give me a 4-unit apartment building. That's the whole property. I'm going to benefit from a lower tax rate through this provision of the law, and I get to live in the top floor apartment because that'll be great for me, and I'll have great views, even though my parents lived on the ground floor. And also maybe I'll be able to rent out all those units, maybe make some money off this. Well, hold on a second. What state law states is that only the principal place of residence is what qualifies for the exclusion, the benefits that Prop 19 provides, that lowered tax rate. So if your parents live in the top floor unit, yes, you can go and live in that same unit. But if they live on the first floor unit or a second floor unit, you must occupy that same unit to benefit from the exclusion. And then there's another caveat. Those other units within the building, all of those get adjusted up to fair market value. So even though you inherit that property, it's only the principal place of residence that benefits from the exclusion. And that's one reason why this part of the bill and the ballot measure was so controversial. There's an exception for accessory dwelling units, ADUs, where the ADU combined with the primary residence together, those do qualify for a full reassessment exclusion. But again, reach out to our office for questions regarding your particular case. So those filing requirements that I mentioned, note the different timing deadlines. I wish it was simpler. It's not. That's why I mentioned the checklist and also following up with our office, working with your advisor or attorney to help you make sure that you're following through on every little item. No question is too burdensome because it affects you. So please don't be shy about questions. I ask them all the time here in the office. If I'm not sure about something technical, people who are specialists can answer those questions for you. But here are some basics. The exemption form is what needs to be filed for the principal place of residency. There's a 1-year deadline there from the date of the transfer. So when you received the property or the date of death, the date of death. The exclusion from reassessment claim that has a 3-year deadline from time of transfer. This deadline only applies if the property has not been sold. And again, as I mentioned earlier, if a deadline is missed, you're gonna have a higher tax obligation until it gets fixed. But once it gets fixed, then there's prospective relief. So after that takes place, everything moving forward, as allowed by law, will be at that lower rate as you can benefit from. So we cannot provide any relief retroactively because the law does not allow us to. All right. So here's an example of a late filing. So you can see here in the slide, say a parent passes away on June 15th of 2022, and the estate plan leaves the family home to the child. In this case, the child files the homeowner's exemption form, one of the forms they need to file, on August of next year. And the BOE 19P exclusion claim form was filed on January 22nd of 2023. So the exclusion claim, the second one, that was filed on time, well within 3 years, but the homeowner's claim was not filed within 1 year. And so you're going to have a higher tax rate until that is being addressed in this case. And then you're only eligible for prospective relief after that change has been addressed. So again, very important to make sure that you're following through on, are you sure this is a deadline? Are you sure you received the form? Working with our office, working with an attorney, working with an advisor, just to make sure that you have all of your ducks in a row, as they say, all your T's are crossed, all your I's are dotted. It's a lot. I wish it was simpler. It is not, but I want to make sure you're aware of that so you can all be best prepared. Okay. Another one. So here in terms of a trust distribution. So this question applies to a city real estate question. What if you have more than one child to inherit a building? So we frequently receive questions about trust, distributions, and siblings. And here's an example. My mother's trust leaves her home to me and my two siblings equally. Will this property be subject to reassessment as of our mother's passing? And the answer is, for the property to be excluded from the reassessment under Prop 19, at least one of the children need to move, or qualified heirs need to occupy the family home within 1 year. Both the exemption for homeowners claim must be filed, and the Prop 19 exclusion claim form must also be filed, both on time, both with separate deadlines, and then you can qualify for the exclusion from reassessment as of the day of death. Okay. So everyone's always thinking that they can get one, find a way around the law or find something nifty through the law that allows them to avoid a higher tax obligation. And one of those is this concept of the LLC, and people's belief that you can use an LLC to avoid reassessment. One question is, I've heard that parents can set up an LLC with their children. You put the house into the LLC, and since ownership doesn't change in the death of the parents, the property isn't reassessed. Is that correct? And the answer is nuanced. It's important to note that LLCs are not always an automatic avoidance of a reassessment, and that California property tax laws that govern legal entity ownership transfers, they're complex, and you want to be discussing those with a qualified estate planning attorney, maybe a financial advisor, because one example where a reassessment would occur, despite the property being in an LLC, is a situation when there is a change in control in which one member gains greater than 50% interest, thereby triggering 100% reassessment of the property. So again, the particulars of every individual situation matter. You want to pay attention to those. You understand the general guidelines, but at the same time, there are very particular questions that need to be asked by you that pertain to your specific situation. So I just want to make sure that everyone is also aware of that. Again, complex, layered, one step, might have multiple paths that will open up a whole new series of questions for you that we can help answer. And then also your attorneys should also be helping you answer as well. Again, if your instinct is telling you, I'm not certain about this, always double check. Always double check and reach out to us and ensure that you are being given the right information and avoiding unnecessary tax obligations that could have been avoided, at the very least, reduced. So let's say in this next example, what if a child moves out? So they were living in the home, the transfer took place, say, oh, that's taken care of, but then one of the children moves out of the house. What happens then? If another eligible transferee, let's say your sibling, your brother, your sister, moves into the property within 1 year of the other moving out, and they also remember to file the homeowner's exemption claim form, then the exclusion continues. So just remember, those timelines are at play again, and then also the repetition necessary of filing a new form, ensuring it's been received, ensuring it happens within the timeline and deadlines, so you can maintain the right of the lower tax obligation based on that lower assessed value. If no other eligible transferee moves into the property within that timeline, that 1 year, then the exclusion is removed, and you're going to see a new value, a much higher value, applied to the property. And then here's another point. As I'm mentioning, talking to you about some of the generalities, the framework, the general rules that guide this process, the same is true, the same considerations I want you to make on the specifics of issues that need to be addressed. Don't fill out your own paperwork. make sure that you're working with someone, a licensed attorney, to help you create those documents. There are various particular rules that must be followed when it comes to how forms are filled out, how the paperwork is filed, all of the legal requirements around that. You want to be working with a professional to make sure that you have what you need, and that you have a true legal document that you can rely on. So while it seems simple to add a family member to a deed or a way to avoid dealing with intergenerational transfers down the road, it's not easy, and it's certainly not necessarily a quick fix. So adding someone to your deed, that may trigger a reassessment, as well as transfer tax obligations that are like a change in ownership. So we want to make sure that you understand all the implications of actions that you may take, and avoiding preparing your own documents is one way to ensure that you're aware of what your tax obligations might be or what you can avoid doing to avoid unnecessary increases in value and the associated increase in tax obligations. So generally, you're going to need to consult with a title company or attorney, both for that correct legal guidance and financial implications, but also to help you prepare those documents. So when you're submitting any document to our office of the assessor and recorder for recording, it's always necessary to review the recording requirements. You can see those on our website. You can also call us up. This applies to not only you can come in to City Hall as well and ask us. It applies to not only real property documents like deeds, but it also applies to things like marriage certificates, marriage licenses, all of that work. I can't tell you the number of times in the past couple of months already where we've had to return a document or have to add corrections to a document, because a signature was out of line, because whiteout was used when it never should have been. So please, some of those seemingly common sense adjustments you might want to make to a document, please do make sure you're reading the instructions carefully, working with our office to make sure you don't make a mistake. I do the same thing whenever I'm preparing documents for marriages in particular, just to make sure there's no reason people have to spend more time on it, more money on it, or just be confused. I want to remove all those obstacles. There are enough that are in place already. So there are state and local laws, as I mentioned, that dictate what information an official recorded document must have on it, like a correct assessor parcel number, signatures, addresses. All that information must be clearly legible. So otherwise, our office cannot accept and record that document. So in your consultation with a title company or attorney, I want to be you to be sure to ask about any transfer tax or reassessment consequences that might apply to your particular situation. Okay. So here's that checklist that I mentioned. This table organizes all the forms and the associated deadlines. We'll be sharing this slide deck with you in the chat section, so you can have this as well. And if you lose it, no big deal. Reach out to us. We're happy to provide you with another one. Again, you can email us, you can visit the website, you can call us, or you can just simply come on into City Hall, and we will be able to help you out that way too. All right. You can hear on this, so that generally I talked about that $1 million adjustment in terms of that intergenerational transfer that we've been talking about, meaning parent to child, grandparent to grandchild. It's a rough number, but it has been adjusted so that it's very specific here. You can see that the new amount is now 1 million plus 44,000 and change. 1 million plus 44,000 and change. So you can see what and how that will apply in terms of the timeline of the acquisition of those properties or the transfer of those properties. All right, now what we're going to move on to is the base year value transfers. That's what I talked about. That was most on our minds when the measure passed. That's around seniors, those with disabilities, those 55 years of age or older who have been impacted by a natural disaster such as an earthquake or a wildfire. This is what that applies to. And this is much less controversial because it offers an opportunity for more flexibility for those individuals who might want to downsize, who need to rebuild, who need to move after a very significant event. So this is coming into play for some people, as an example, in Los Angeles right now, based on those fires. And there's additional state law and adjustments being made to help people in the rebuilding process and recovery process as well, for the benefit of them, but also the entire community that's been impacted. So what this portion of the law provides is that the base year value law allows an eligible homeowner, when they move to another home, to transfer their low protected factored base year values to that replacement home, i.e., go back to that earlier slide at the beginning of the presentation. You can take the lower value blue line and carry it with you to a new property with some catches. So where do I find that blue line in relationship to my property? It's on the notice of the assessed value that I send to you every single July, every single summer. Transfers can occur anywhere in the state, and an eligible homeowner, based on what I said earlier, seniors, those with disabilities impacted by natural disasters such as earthquakes, floods, fires, you're able to transfer that base year value up to 3 times. So you can move 3 times. There is no longer a limit to the replacement property. Before Prop 19 was the law of California, the replacement home that was being chosen had to be the same value or lower of the home's market value in order to qualify. So as I mentioned, this makes it much easier for someone to say that, listen, if you want to move to another property, let's say it's $100,000 more, you still can. There's not a restriction on that. However, let's say that you have a $192,000 assessed value property, just for the purposes of small numbers. You move into a property that's worth $300,000. You're going to be seeing the difference between. I'm sorry. You're going to see the difference of your market rate property and the new property. The difference between those that gets added to your assessed value. So you still maintain the benefit with a little bit more added on top if the new home is worth more than your former home. Okay. So who is eligible? As I mentioned, I went through all of those: 55 or older, severely or permanently disabled, a victim of wildfire or natural disaster. And then here is another component. As the law currently provides, the replacement home must be purchased or newly constructed within 2 years of the sale of the original property. And then the homeowner must, again, occupy the original property and the replacement or the replacement dwelling as your primary principal place of residence, where you live. So the home that was destroyed, you were living in it. The new home that you're moving to or that you're newly constructing, you're also living in it. That is a requirement to benefit from this aspect of the law. Okay. Let's see here. So here's an example. Proposition 19 requires our office to apply a valuation test to the reassessment exclusion claim. So the value limit for the exclusion is a sum of the factored base year value plus $1 million. Any excess market rate value beyond the value limit is added to the new base year value as the property's new base year value. So you can see here, again, the home had an assessed value of $250 and was sold on August 15th, 2024 for $1.2 million. The new replacement home was purchased for $1.5 million. So you can see here, there's a $300,000 delta between the new home and the old home, and that $300,000 is going to be added to your existing factored base year value. So you're not being charged taxes on your $1.5 million replacement home value, but rather the combination of what you're currently being taxed on, plus that delta between the 1.5 and the 1.2. I know it gets a little complicated. It's great to write it down in your specific situations just on paper so you can understand exactly roughly what your new tax obligation may be if you're in a situation like this one. Okay. Again, here is a checklist for you. Again, those filing deadlines are very important to pay attention to. The forms that you have to fill out are also important to pay attention to you. And again, even after you talk to your attorney, making sure that they or you are just confirming with our office what is administratively required by law for you to fill out and by when. For you to fill out which form and by when. All right. Many people are asking, what is happening with Proposition 19? Will it be repealed at any point? And the answer is there have been some attempts, but they've never met the threshold for them to occur. So an amendment measure may appear when there's a proposal by the state legislature with a 2/3 vote from both the Senate and the Assembly. We have not seen that. Or there's a citizens initiative with valid signatures of registered voters that are equal to 8% of the number of votes cast for the governor in the last election. So unfortunately, for those who have been interested in seeing a change to Proposition 19 to revert back to the rules of the past, specifically for the intergenerational transfers, parent to child, grandparent to grandchild, they've never been able to collect enough signatures to reconsider this and bring it back to the voters. And it's important to remember that there was a lot of money that was spent on moving this measure forward. So there's also going to be financial considerations on how you educate voters, get them to understand exactly what this means, and clarity of language and thoroughness of language, if and when this eventually occurs, or if this occurs. So right now, Proposition 19, as I've presented it to you, is the law of California, and we have not seen any significant movements that would change that fact. Here's some resources. You have the Board of Equalization, which we report to and make presentations for at the state level. They have some Prop 19 guidance and questions and answers for you available online, as you can see here. And then, as I mentioned, of course, you can always reach out to us and we can help get you connected. So there is no wrong door from our perspective and from my perspective. If you have a question of wanting more resources, you can always just reach out to us of like, wait a minute, this guy just talked to me about these resources. I don't remember what else is available. Just reach out to our office, come on by to City Hall, email us, call us. We can get you connected. All right, and then those low-cost legal resources that I mentioned at the beginning of the call. Housing and Economic Rights Advocates, HERA, in California, are our primary partner for estate plans that we're providing in the city with no taxpayer concerns, philanthropically funded. They're also available to be a legal resource for you here. Legal Assistance to the Elderly has been a fantastic partner, as has Open Door Legal, and they are positioned to help those who need some lower cost legal resources to help you consider what steps you may need to take or that you want to take so you can best understand your options. Okay. As I mentioned, we launched an estate plan program to deal with the discrepancies in who has taken advantage of an estate plan to ensure there is security around how your home may be transferred for whatever reason, because of a death, because you become incapacitated physically and mentally in some way, and there's a legal document that guides your assets. We have made this available for free or for low cost, depending on income, whether you're low or moderate income. And we focus this primarily in the southeast part of the city and the Western Addition, because the national statistic is 70% of African Americans in the country do not have an estate plan in place. Why is that a significant concern? If you don't have an estate plan in place, then the courts need to take on the responsibility of knowing what to do with your assets. The typical cost for going through that process, probate process, let's say the average price of a home is $1 million. A $1 million home will typically cost $40,000 to process through probate. I don't know about you. I don't have $40,000 just lying around to spend on that. So what happens in that case for someone who's just became house rich, but maybe cash poor, is they need to draw equity out of the home, and maybe that home needs to be sold to liquidate the assets, so they have costs to help distribute assets, and the home is lost. So it's very, very important to take advantage of an opportunity like this for yourself, for your friends. And as I mentioned, it's HERA, Housing Economic Rights Advocates California, who is our partner in doing this work. And they are happy to take your calls. We'll have information for you in the chat. And then key deadlines. Some of these apply to you, and some of them are just about how we do our work. So for those of you who are single-family homeowners, every year when you get that notice in July, that's based on a certain point in time. That point in time is January 1st, what we call the lien date. For those of you who are seeking exemptions, that deadline is February 15th. For those of you who are single-family homeowners, small property owners, condominium owners, you have a process to appeal that is outside of the formal process with the independent AAB. That is our informal review process. That just closed at the end of last month from January 2nd to March 31st. If you miss that opportunity for this year, you will always and still can maintain your right to reach out to the AAB once you have a chance to formally file an appeal, which can take up to 2 years to resolve. So again, when you receive a property tax bill, pay that bill. Pay that bill. If you don't pay it, you are subject to penalties and fines, period, because that's what the law dictates. And for questions around any question related to your bill, while we're happy to refer you over to them, those are issues that are managed, questions that are answered by the treasurer and the tax collector. So they take care of the bills and we do the valuation. And then on June 30th, that's when we close our roll. That's when all the value of all the hundreds of thousands of properties, parcels, the land, the improvements on them, a little over $351 billion of assessed value. That's when we close that roll and that value gets placed on it, which then provides the basis and foundation for your value and the bills that eventually come your way from the treasurer and tax collector. That leads and adds up to about $4 billion in property tax revenue that supports our schools, our infrastructure, our support for homelessness, mental health, public safety, clean and safe streets, parks, so on and so on. All right. In real property, commercial, residential, in July, you receive a notice of assessed value from us. In October, you get the tax bill from the treasurer and tax collector. And then you have those 2 due dates, one in December and one in April. Again, even if you have a valid argument to lower your assessment, until that's been corrected, you must pay your bills on time. That is the law. You must pay your bills on time, that December one, that April one. If you don't, you are subject to penalties and fines. And if you don't pay them on time by the exact date on which they're due, by that date, you will receive a penalty and a fine. And they don't have, in the treasurer and tax collector's office, the ability, the flexibility to make a change to that. So I had the heartbreaking example of a senior woman who had forgotten the deadline. She came in within hours to correct it. She still was subject to essentially $600 worth of penalties, fines, because she missed that timeline and they could not make an adjustment there. So please, 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 I know it's very stressful. I know it's hard always making those payments on time, but know that the alternative is worse and there is not a way for us to correct that process. So I know it can be cumbersome, but that is how the system has been set up per state law, All right. And then finally, business personal property and possessory interests for small businesses, their improvements, they have a totally separate schedule that's condensed. July, the notice comes and the bill comes. And then in August, that tax bill is due. All right. Do we have, and then again, as I mentioned throughout the presentation, you can always come and visit us. These are our city hall hours. And just remember, we do close right on time and we open up right on time. You can visit us at sf.gov/ASR. And you can also call us here at this number. And remember, if you forget, 311 and say, I want to talk to the assessor's office, or I want to talk to the treasurer and tax collector's office. But 311 is a great resource. We have a great system for responding to calls in case they cannot reach us, and we're able to follow up with you as quickly as we can. We aim for no more than 48 hours. Sometimes that doesn't always happen, but that is our aim. We want to make sure that we're getting back to you. And again, you can always email us at assessor@sfgov.org, or just come on into City Hall, room 190, first door on your right when you come in from Polk Street, and you go through security. We are the office right on your right, the office of the Assessor Recorder. Thank you so much. And I'm happy to take any questions if there are any on here right now that I can answer. And I don't know if staff has already begun to answer some of these questions or type them in. Yeah, I'm here. So give Californians a chance. I'm gonna read some of these that are comments, and then we're gonna add the link and we're gonna send the presentation to everyone on the webinar. So I'm gonna go through some of these as I am able for the next 10 minutes. Yes, I understand that. So there are a lot of very much valid concerns and arguments. I've been going out and talking to people about my concerns about how this bill was passed and not transparently. That's why I talk about when the sky was orange and day was night, because when you receive that ballot, it was very clear, or so it seemed to many of us who were voting at that time, that this was about helping our neighbors up north who have been impacted by those extraordinary fires. And that was not the full reality. There was the changes to intergenerational transfers. And unfortunately, that is the law of the land now, that because it passed by a slim majority on November of 2020. So I just want to say to Sherry, thank you so much for putting this in there. I totally understand, and I'm very sorry. These are the realities that we're facing now, and my job at this point is to help people understand exactly what's going on. I want to share with you that we're in contact with the Howard Jarvis Taxpayer Association. They're the ones who have been leading the charge on signature gathering. And again, they have a huge mountain to climb in relationship to that. But unfortunately, the reality is that over 50% of voters voted for this bill, voted for this measure, and that's why it passed. But I just want to be able to share that. So I do appreciate it, and I recognize your concerns, Sherry. Thank you for sharing them. Yes, you want to wait until the date of transfer to begin the process. Data process. So it's not always about death. Sometimes that transfer occurs without a death happening. The reality is, Evan, you have the 3 opportunities to do so. It's just that flexibility that's provided. I'm not sharing that I believe that it's common sense, but for some individuals, you never know, especially in California these days, who, how, and where someone may be impacted by a natural disaster. By the luck of the draw or by choice. And again, the tenets of that measure were grounded in, if I'm a senior, I want to be closer to my family in Los Angeles or closer to my family in another county in California. I have the flexibility to do so. I want to downsize. I want to be closer to them. I have that ability to do so. And that might change over time. For those specific concerns, please do reach out to our office around TICs. I know it's not the answer to provide to you that's satisfactory, but reach out to our office so we can dive into that more specifically around how Prop 19 and TICs work. In terms of why it's been unsuccessful to get this on the ballot, it is going to take both a lot of organizing from Howard Jarvis Taxpayer Association, plus a lot of money. I do not see the legislature picking this up because of the tax implications and revenue implications that are of concern to the state of California. And that's why you're not seeing bills like this move. That's why you're not seeing changes to the exemptions for disabled veterans change. That's why you're not seeing the value of the homeowner's exemption of $7,000 change. The revenue concerns for the state of California at the state level, in the Senate and the Assembly, and the associated committees, all those concerns also remain the same, which is why you're not seeing the movement, in my opinion. All right. I am going to ask, I don't know if people have answered some of these questions already. With regards to the question around the estate plan program, anyone can reach out. Anyone can reach out. The reason that we focused on two parts of the city, Western Addition, focused is the operative word. Anyone can reach out to us and qualify for this program. The reason that we chose the Western Addition and the reason that we chose the southeast part of the city is because that's where the high levels of home ownership and the concentration of communities of color aligned. And that is one of the reasons why we focused in those areas. Again, no one is being turned away who reaches out to HERA to ask for services, and there are still slots available. But that has been our focus because that is where we saw the opportunity to meet the needs very specifically in those two areas. So please do those more specific, very more specific questions. Please do reach out to our office. And also, if any of the staff is available to start answering some of the questions in the answer section as you have been, would greatly appreciate it. And I apologize, the system only allows me to look at what is open in terms of questions and then what are answered. And some of them I think are crossing both in real time. And again, per those questions, anyone can reach out to HERA as provided in the handout to ask them about how you can qualify for the questions you have about your own needs. And again, Sherry, I understand your anger and your frustration and concern, and that's why we're getting the word out about this. I'm still looking through here. And again, just on these very specific questions, these are much more nuanced. So just to make sure that you're reaching out to our office and working with an attorney when you're truly considering the changes. And for Catherine, when you're asking about the timeline, please do refer to the checklist in there so that you're very clear on what the timelines are for your specific situation, whether you're pursuing the intergenerational transfer or whether you're pursuing the benefits of Prop 19 in relationship to the base year value transfer, which is when you're impacted by a natural disaster, when you're severely disabled, or you are 55 years of age or older. The assessed value that you see here is based on the value that is applied when there is an assessable event. So an assessable event is change in ownership or when there has been new construction that's take place on the property. Sometimes those neatly line up with the market rate value of that property. Sometimes they do not for a variety of reasons, because the nature of the transaction may not have been at arm's length. But typically, the price that you pay is what the assessed value is. It's a general rule, but there are caveats depending on the specifics and the review of the appraiser in relationship to the nature of your very specific transaction. So sometimes people say, well, that's what I paid for it. Yes, but there might have been variables in relationship to the property. Or wait a minute, I paid for this construction that my contractor said was this amount, but you say it's $10,000 more. Well, because the contractor may have been sharing with you, you were getting a good deal on it, but the value of that work, when you look at comparables and the price that others are paying holistically throughout the region for the same area, the same property, the same type of improvement, the market rate value of those improvements might actually be higher than what you paid for them. And so that is a process of valuation that takes place to ensure that, number one, people are paying the fair share that's also accurate, and also ensuring that we're catching those variances as it pertains to your ultimate assessed value. And remembering that your assessed value remains constant, increases by no more than 2% each year. If you have an improvement, that is then added on to that. It does not move the entire property up to market rate value. There are very specific circumstances in which it does. If the property is changing hands, the parent who lives in the property, they must be living in the property as their primary place of residence. So it can't be a secondary property, a vacation home, and then transfers over to the child for the benefit of Prop 19. It must be where you live, and it must be where the child lives. It must be where the grandparent lives. It must be where the grandchild lives. And all the deadlines and timelines associated have to be met, and the forms have to be filled out. And yes, with regards to before Prop 19 took effect in February, in relationship to intergenerational transfers, our office saw a rush in the middle of the pandemic. And I came in a couple of weeks before it took effect, back in 2021. A rush of thousands of desires to make those transfers happen. Some people were happy with that, and some parents were very upset with that because they're now concerned about where are they going to live based on the transfer of their home. Because as you is important to remember, not every family is a family in the good sense. There are complicated relationships between parents and children, grandparents and grandchildren as it relates to property and money. And that's unfortunately the case in some circumstances. So there were some people who rushed and wish they hadn't rushed to make any changes.